there are more opportunities to take advantage of incremental tax losses that happen throughout the year. And this is what's called tax loss harvesting. So when you own an ETF or a mutual fund, you can't do tax loss harvesting as frequently because you would need the whole fund to decrease in value from when you bought it. And when you have more tax losses, you have more leverage to offset those losses against gains elsewhere in your portfolio, or in this instance, with concentrated company stock. So direct indexing is also really cool because it can adjust to your unique tax situation and your specific investment preferences. So for example, if you had environmental social governance preferences, those are often called ESG preferences, or you want to avoid investing more in your company or in your industry, direct indexing is a great way to do those things. It also helps you avoid wash sales, which is one of the things we talked about earlier. So Monument relies on really advanced software to do this for our clients. So all this is to say is that direct indexing is a really powerful tool, but it's really difficult to do on your own. And that's where a good wealth advisor can add a lot of value in this space. And I know you mentioned the episode we have on stock compensation. I do want to point out also we have an episode that delves a lot further into direct indexing with Pat McStay from O'Shaughnessy Asset Management. So we can link to that as well.
Fantastic. It sounds like there's a ton of opportunity for customization there, which is so helpful for people who have these really complex financial lives. Mm-hmm. Something else that can go a long way in building a sell strategy is tax planning beyond just the tax loss harvesting that you mm-hmm. mentioned, Jessica. So an exercise that I like to do with people is mapping out their future vesting for RSUs and options to get a sense for what their tax bill is actually going to look like year to year. There will be things outside of your control, like restricted stock that vests, and that's mm-hmm. just taxable income that you're going to have to realize. But then there's also things that are in your control, like exercising your options, either incentive stock options or non-qualified stock options. So by mapping this all out for people, I've seen this actually spark decisive action. Mm-hmm. You can really start to build a strategy based on facts and numbers versus feelings and assumptions about what the tax impact would be of selling to diversify. Mm-hmm. So the tax planning does go a really long way. Don't have time to dive into all of that today, but I think it's always helpful to have some kind of visual that helps you really pull this all together and really see, to your point, how stock options fit into the entirety of your wealth plan, not just a piece of it. Mm-hmm.